Hey guys, it's Matt back with another video, going back to my roots here, because when I started covering stocks on this channel, I actually used to cover a bunch of SPACs. I was very SPAC focused, and I used to get a lot of my initial SPACs that I like to cover from Reddit, just to see what everybody was talking about, what kind of due diligence was being done, and fully vetting it, going down the rabbit hole and learning as much about these different SPACs that were being covered as I could. And it seems like it's been quite a while since I've actually done that. And I've just been reading up on a particular SPAC that has me really intrigued to the point of where I've actually invested in this. So the SPAC itself is STIC, ticker symbol STIC. Now, I've previously covered this one very, very briefly. I didn't do a full due diligence coverage on this, and that was specifically because I was covering a move that Sir Jack-a-Lot made. And if you've been watching this channel for a little while now, you know every so often Sir Jack will make a move on Wall Street Bets, post about it, and he will typically swing from his entire portfolio being in one stock over to another stock, over to another stock. And there was one point in time when he actually completely invested his entire portfolio into STIC and sold 2 days later. And he posted about selling it because he legitimately just got incredibly lucky, because the CEO of Bark Box, which is the company that STIC is going to be merging with, went on CNBC and had an interview which was more or less an unexpected PR event for STIC, which then brought more attention to it. People started buying the stock and it shot up like crazy over that one day. And so as lucky as he got, I don't blame him at all for selling, simply because it was just a very, very lucky, well-timed move. But now that I see how much this SPAC has sold off, just due to the fact that when the market crashes, when people try to get out of tech, and as we've been seeing, the last 4 weeks have been quite a bit of a bumpy ride, more so on the red side than the green side, SPACs tend to suffer disproportionately to the rest of the sell-off. And a lot of that happens to be because SPACs are still kind of speculative. A lot of these companies that SPACs merge with don't necessarily have revenue. In this case, Bark Box does have revenue. I really like the company Bark Box. It's not something crazy that is going to generate 1,000% returns or anything like that. But I feel like this company is a very, very safe bet. And when I say that, I say it with a grain of salt. I think the better way to say it would be it presents an asymmetric risk-reward ratio favoring the reward side. So I'll put it that way, because as always, there's always a risk. I'm not a financial advisor. I highly advise all of you guys to do your own research, check my sources, double check everything I put out there. But with that, let's jump into it. So the first thing I want to cover is the first paragraph of this person's post. So this person's username is Ugday, and they posted their due diligence on STIC 5 days ago. This first paragraph, we're going to read this out loud. In the recent 33rd Roth Annual Conference, which was held on March 8th, Northern Star, which is the acquisition company that formed the STIC SPAC, chairwoman Joanna Coles said that STIC will be merging with Bark in early April. Now, if you're watching this video as it comes out, or the week that it comes out, it's March 27th as I'm filming this. That means STIC will be merging with Bark in the next couple of weeks. Now, this SPAC was formed on October 26, 2020. And as you can see here on my screen, switching over to the SEC filings, this is the latest S1 prospectus for STIC. Usually, companies don't merge that fast. They don't reverse merge with a SPAC that quickly after SPAC formation. It's only been about 6 months. Usually, they have 2 years, anywhere from 18 months to 24 months, to actually find a target and complete the merger. In this case, it looks like they're pushing a pretty aggressive timeline for having this merger go through. That's fine with me. I love it. Just looking at the fact that the market is red, everything's been selling off. SPACs tend to sell off disproportionately so. Like I mentioned before, you have a merger coming up in the next couple of weeks, and what usually tends to happen with SPACs, if you've been trading SPACs for a little bit, as the merger comes, there tends to be a spike in the price. Now, I'm not going to say that that spike will hold because I've already gone through my fair share of different SPACs that I've held through merger that have dipped right after merger. And looking back, I can tell a lot of that has to do with lofty valuations. Now, in a market where we have lofty valuations, for some reason, SPACs just haven't really been holding their lofty valuations post-merge. So I see there being a big risk with a drop-off after merge. Now, I may be completely wrong. Who knows? I don't have a crystal ball. I can't tell what's going to happen after the merger. But in my eyes, in the short term at least, I see this as a pretty solid play. I see it as a solid play just for the long term, as long as you're willing to hold through any kind of dip after merge, if that happens, and any kind of dip after that, just because who knows what the market as a whole is going to do. And STIC, of course, becoming Bark, is not going to trade completely separately from the market as a whole. If the whole market is red, then of course you can expect Bark Box to go red as well. But with the stock having gone on this really kind of painful slide from a high of $19 down to under $11 currently, it's in the high $10, almost at its NAV price. NAV or NAV is the price that a SPAC IPOs at. So when it IPO'd on October 26, 2020, it had a price of $10, which is pretty typical for SPACs. There are very few SPACs that actually IPO at a different price than $10. And as SPAC hype has done its thing from October, November, December, January, and has slowly been dying off now, this is very close to that NAV price, which in my opinion is quite a good deal. So all right, enough about what the price is currently at. Obviously, clearly, I think this is a good play, at least in the short term. I believe it's a good play in the long term. However, in the midterm, I do see probably a sell-off just because, like I mentioned, with the mergers themselves, sometimes you see sell-offs, sometimes you don't. I tended to see sell-offs more so than not. So who knows in the midterm. But I want to give you guys a high-level overview of what Bark Box actually is, and I have another post here. So we're going to go back to that original post because that post actually does a really good job at summarizing bull and bear cases for this Bark Box merger with STIC. But this post here does a really good job at explaining what Bark Box is. So we're going to thank the user, the Ultra Violence, who posted over in Wall Street Chads. And we're going to look through this article to find out what Bark Box is. So Bark Box, it is a subscription service where you basically get toys, treats, and chews for your dog. Now, this subscription service starts at a price of $23 a month, and it boasts a value of the products within the box at $40 or more. The reason they can say that they're giving such a good price on the subscription service is mainly because if you go and take the stuff that you find in the box and you go to PetSmart or Petco or any other kind of retail store, you probably will pay anywhere from $35 to $45 for the stuff that you have in that box from Bark Box. How is Bark Box able to sell this stuff at the price that it does? Let's go into that. So as we mentioned, $23 a box, starting price. They boast the value at over $40, free shipping, so you don't ever have to worry about that. And then once a month, you get this box and it shows up at your door and you get to have a great time with your dog. The stuff inside the box, as we mentioned, toys, treats, chews. Do people actually like Bark Box? Well, if you go to Google and you ask what is the best monthly dog box, you will see that best overall, Bark Box. Now, if you tend to cut back on your budget and wonder why somebody would spend $23 a month on something like this, because at the end of the day, you are talking about just under $300 a year on dog toys. In the market that we're in the economic downturn that we may be going into, that there are people losing jobs right now with COVID and all different kinds of different reasons. Why would people continue to spend money like this on their dogs? So looking at this quote right here, Lend.edu surveyed 1,000 American pet owners to ask them about their spending for their pets and how it affects their personal finances. 20% of respondents have gone into debt caring for their pet at an average of $1,566.96. 45% of people taking the survey showed they spend as much annually on their own healthcare as they do their pet. Now, Bark Box specifically focuses on dogs and no other pets. Now, if we look at a survey of 1,000 adult Americans on what type of pet they currently have, 72% of respondents answered dog. So owning a dog is the most likely kind of pet you're going to run into when you run into pet owners. So BarkBox, they are focused on dogs because it is the largest market share for pet owners. And when you look at how much money is spent by dog owners on their dogs, you'll see that it is also the largest out of all the pets. Dog owners answered an average of $157.39. This is inclusive of healthcare costs, insurance costs, food, toys, and accessories. So on average, if dog owners are spending $157, $23 a month doesn't really sound that high anymore. Now going back to the original post over at our SPACs, let's learn a little bit about how the business operates and what the bull case is for BarkBox. So going through this article, like I mentioned, they put it together very well. I'm highly impressed with this post. They've clearly spent a lot of time putting this together. So first and foremost, they cite that it's a simple, straightforward business, and I'd have to agree. It's a subscription service. They give you toys, chews, and treats for a price, and it shows up at your door once a month. Pretty simple, pretty straightforward. They have a laser focus on the dog space, like we mentioned. They don't cover any other pets. All they cover is dogs. Potential expansion into other business lines, namely Bark Eats. So actually, if we take a look at that other post, we'll actually see there's a few different areas that BarkBox is expanding to. So they have the Bark Eats line where they can include food within the subscription service. Bark Bright, which is all focused on dental health and dental treats. And Super Chewer, which is a separate type of box from the $23 a month box. It's a $30 a month subscription for dogs that are just geared more towards chewing products and destroying their toys. So the Super Chewer box is a little more expensive because the toys and chewers included in that box cost more to make. And all of these different boxes, of course, add to the bottom line and the revenue of the company. We can also see here that they are going to be expanding into other geographies. So when I was looking into this, what I was really curious about is what the competition is doing. So Chewy is a company that was bought by PetSmart in 2017, who made the GameStop Lord and Savior Ryan Cohen some incredible attendees at $3 billion. Chewy doesn't ship outside of the country. Chewy also isn't a subscription service, so it is not a one-to-one comparison here. But I was just looking at what other pet supply companies are doing as far as offering the service outside of the US. And Chewy does not, and they're one of the big players in the game. And so I was highly interested when I saw that they're expressing interest in expanding abroad. Looking at numbers, financials, and growth, they point out that it is a non-zero revenue, which is very, very nice in the SPAC world because a lot of the times there are speculative SPACs that do not have revenue. They have really impressive Q3 earnings, and their growth overall has actually taken off through 2020, as have many other companies. For example, Roblox has just gone nuts ever since the pandemic took hold, simply because people being at home, they play the games. Same thing with BarkBox. People staying at home, playing with their pets, and just wanting to spend more time with their pets and spending more money on their pets. So subscriptions have gone through the roof, so to speak, for BarkBox during 2020. And it looks like here through December of 2020, they're at roughly 1.7 million subscriptions. Now, going back to what I was mentioning before about how does BarkBox offer the amount of toys and chews and treats that they do at $23 a month when it's said that the value is over $40? Well, that's mainly because they create a lot of these toys in-house. It's vertically integrated as far as the creation, design of these toys, making them and putting them in the box. They aren't buying them. They aren't acting as a middleman. They aren't buying this from wholesale distributors and then just putting it in a box and sending it out. They're actually designing, creating these toys, throwing them in the box, and then sending them out. So because of that, their margins are a lot lower when it comes to what they spend on these toys. Now, I'm going to briefly touch on some of the headlines here. Excellent product development, like I was mentioning before. Excellent customer service, strong marketing, social media presence, bullish trends in a growing pet market, scarcity of pet stocks. So there aren't that many companies out there that are publicly traded that are in the pet space. decent meme potential. So sincerely, that is something that we actually have to look at, because you never want to underestimate the power of Reddit or any other social media when it comes to sending a stock price flying. GameStop. And then, of course, we have the valuation. Assuming a share price of $12, Bark's equity value over their 2022 sales multiple is roughly $2 billion over $515 million times 1.2, which equals a 4.66 multiple. This isn't cheap, like they point out, but it's not bad, just reading from this. The reason they say it's not cheap is because Chewy has a equity value of over 34 billion, and when you take their sales multiple of 8.9 billion, their multiple is 3.83. But we have to understand, Chewy's share price is over $100. So naturally, the explosive growth that Chewy had is what we want to see from BarkBox over the coming year to 2 years. Now, if you look at Freshpet's multiple, 6.47 billion of equity value divided by 430 million sales multiple, they're at a 15.05 multiple. And BarkBox is growing at a faster rate than both of these companies. So for me, I can really see this share price of this stock taking off after it merges with institutional investors getting in, as long as the growth continues on the upward trajectory that has been going on. And I don't ever really see it going down. It can slow down simply because of that injection of subscriptions over 2020 due to the pandemic. So it can probably tail off as far as how fast it was accelerating, but I don't see it reversing course and subscriptions being lost and them having just revenue plummet. I don't see that in their future. So to me, this seems, like I mentioned at the beginning of the video, I see this as more heavily favored towards the reward side than I do the risk side as far as investing in this company. Now, touching on the bear cases, this article goes into the fact that it's not a sexy business, right? It's a box with dog toys and it gets sent to your house once a month. This isn't Tesla, this isn't any of these ARK funds or anything like that. Some of those other services that I was pointing out, like Bark Bright and Bark Home, which is actually one that I didn't touch on, but Bark Home focuses on leashes, collars, beds, that kind of stuff. The revenue from that is not necessarily growing in lockstep with the other box services that they're expanding to. So some of them are taking off, some of them aren't, but overall they are seeing some nice additive value to their revenue, to their bottom line from those additional offerings that they now have out there. And then in my opinion, one of the probably biggest bear cases is its competitive advantage. There is nothing that really can stop, Chewy or any of these other pet companies from creating their own subscription service. Now, it's not necessarily in their wheelhouse right now, but who's to say they can't do it in the future and take some of that market share? This is definitely a risk. And then lastly, the audience for BarkBox, currently the demographic is at 85% women. So because it so heavily favors one demographic over another, that is seen as potentially a limiting factor for its growth in the future. Another brief article I just want to touch on is from Seeking Alpha that came out in the beginning of February, so almost 2 months ago, where Fishtown Capital, this individual investor, created this post on BarkBox and its merger with STIC, and said it was a compelling buy back when it was $14.50. I'm not going to go into everything that they have in this article. There is some great information in here, specifically around its valuation in this section. However, down below $11, it only boosts the case for STIC and BarkBox. So that's particularly why I see this as such a solid buy right now, is because of this sell-off and how SPACs have just gotten absolutely destroyed during this market sell-off. I just see an opportunity. So if you're holding this, it's an opportunity to buy more shares. If you're not in this, it's an opportunity to maybe see a sizable bump as we lead into the merger and as more people realize that this is coming up on its merger. And then lastly, that leaves me with, what am I doing? What have I done? How many shares have I bought? What is my strategy on this stock? So I currently hold 150 shares at, I believe it's roughly $10.75, somewhere in that range. It's the high tens. I'm expecting there to be a bump somewhere to the $13 to $15 range. Now, I'm just going to use an example here for the kind of strategy that I'm going to employ on this stock. As we get closer to the merge in the coming weeks, let's say it absolutely rallies to $15. Now, keep in mind, this is a big if, because if the market keeps selling off, then I don't see it taking off at all, simply because people will not invest in a speculative SPAC when there is a market sell-off. So this is a big if. But let's say that the market starts to turn around in April because we're at the end of Q1, institutional funds are rotating back into tech because everything is seen as a discount. This is what I'm hoping, because I'm very heavily invested in tech. But I can see institutional funds getting back into a lot of the tech stocks. And as people see the market jump back up, and as it rotates back into tech and all these other stocks and SPACs that have been pummeled as of late, I can definitely see the case as this merger gets closer and closer for this stock price to actually do really well. So let's just say that it hits 15 bucks. If it hits $15 at the current price that I bought it at we'll just use a round number of $11, I would sell a portion of my shares to cover my initial investment. So what that means is, if it hit $15, of my 150 shares, I would sell 110 shares to recoup my initial capital of $1,100 into STIC, and I would hold on to those 40 shares. Now, those 40 shares are pure profit. I like that strategy simply because at the end of the day, I can fully detach from it. So if it sells off after the merge and it hits a value of $7, I don't know, but it hits some really low value, that's okay, because those 40 shares then are pure profit. I can wait. That it doesn't matter to me. I don't need the money. I can wait for the company to do well over time and to take off, and I can keep reinvesting as it drops and buy more shares. I like the company, so there's no reason why I wouldn't. But we always have to remember that investing in the stock market is very psychological. There is a mental component to it, because it hurts when the market dips. It hurts when it's red, because me having such a huge focus on time and looking at money as an asset that can be traded for time, as you lose money in the market, in my mind, it's almost like I'm losing time, and that to me just can make you go crazy. And it becomes very, very hard to want to hold on and not just sell off everything, because you just want to secure your money and make sure it's safe and make sure that it's not going to continue to plummet. This is very, very hard to fight against when you see your stocks going down. But over the long term, as you hear from many different YouTube channels, as you hear all over the place, stocks tend to rally back up. Every complete bottom where a market has completely crashed, if you look at the following 3, 4, 5, 6 months, year after, you will always see that the previous highs were surpassed. So as long as you're investing funds that you don't need now, we're not talking about investing your rent, your car payment money. We're not talking about investing any of those kinds of funds. If you think of this as your savings account that you just keep tossing money into occasionally to keep building and investing, then it's gonna be okay. So always try to remember that in the back of your mind. And as I go through my strategy with STIC, if it plummets afterwards, it's okay. It's fine. I'll just buy more, and I can hold out until it comes back and surpasses its previous high value. And I think it will easily pass its previous high of $19 by the end of this year, most likely. Maybe by the end of the following year, but I really don't see it taking that long. And so with that, guys, that's all I have for today. If you're not investing currently and you want to get 2 free stocks with Webull with a deposit of $100, it's a minimum value of $8 per stock, so that's $16 in stocks given to you for depositing only $100 on Webull. You can use the link down in the description. If you want to talk with me or any of the other video watchers who have decided to join our Discord channel, it's completely free. We talk about anything and everything. The link is also down in the description for that. If you've enjoyed this video, please consider subscribing. Don't forget to leave a like. It definitely helps me and the channel out. And until next time, guys, see you.